Hey guys, how's it going? It's Andy from ROKU Investing. Happy Wednesday. Before anyone says it, yes, I desperately need a haircut, but I cannot do that. So we're going to get to the point where I'm going to start wearing hats in these videos because my hair is getting pretty unruly at this point. But in today's video, I wanted to first recap what's been happening since I last made my video on Monday, talk about what's happened in the market and why we've seen volatility come back where we did not really see that in the past couple days. So on Tuesday, the market fell just a little bit, and when I put up the chart of the percentage moves that the stock market's had for the past couple weeks, you can see that we've had a lot of volatility in the past couple weeks, and then yesterday was relatively stable. And then we look at Monday and we see a 3% day, and I didn't even register that on my radar of moves that the stock market had. I've kind of gotten to the point where 3% is like nothing to me at this point. A couple months ago, if you told me that the stock market moved up or down 3%, I'd be pretty impressed and kind of trying to figure out what's happening. But now 3%, with the way things have been going, has not been that volatile to me. So there are two big news stories that have pushed the market down today. The first one is Trump coming out and saying that we're going to have a very, very rough next 2 weeks when it comes to coronavirus. And then the White House coming out and saying that we might have 100,000 to 240,000 people die as a result of the virus. And that kind of spooked the market. In addition, the big news from this morning is that the automakers and the manufacturing sector is expected to announce bigger than expected losses, and that's really going to hurt. So far, the only people that have really announced stuff has been Chrysler Fiat, which announced a 10% drop in their sales for this past quarter, and it's expected that more of the automakers are going to see similar data. It'll be really interesting to see how the market reacts to the economic data that we're going to see on Thursday and Friday when it comes to the jobless claims and the unemployment rates. And in the past week, I've been very vocal about me kind of seeing that the market didn't really react to last week's record unemployment rate. And it was mainly because the stimulus bill came out at the same time. So if there's no other positive news stories, I'm expecting the market to fall a lot on Thursday and Friday as a result of these numbers. Before we get started, I gotta say that I'm not a licensed financial advisor, and I highly recommend talking to a professional, someone that can find you the best places to put your money going forward. And I really appreciate if you hit that like and subscribe button, as it would help my channel out a lot. This video is gonna be a lot of my own opinions for how I trade and pick stocks, so you should do your own research, and this is just one way of doing it. There's a million different ways out there. So in my last video, I talked about the potential that I see that the stock market goes up or goes down. And you can argue about that as much as you want, but something that I think we can all agree on is it's getting towards the time where people need to start identifying stocks and companies that they'd like to take positions in the future. This could be you want to buy them for a long-term position, or you think that they have a lot of short-term potential. But trying to see the discounts that you can find on the stock market is a really big way of making money as the market falls. I wanted to go through my criteria, which is how I find the stocks and how I do the research on whether or not I want to take a position. All this is obviously speculative. I'm not going to be taking a position in any of these stocks, but I wanted to do this with stocks that I haven't really talked about a lot. I've been very vocal about the companies that I do own, like Twitter and Snapchat, but during times like this, speculative stocks are not the stuff that I'd be looking at. I've had a lot of success in the past trading Snap, Twitter, and stuff like ROKU, where I made around 35% in a couple weeks. But during times like this, I've mentioned that speculative stocks are the ones that often give back their profits a lot quicker. And so during this video, I'm only going to be talking about blue chip stocks, stuff that's in the Dow Jones, the 30 biggest companies on the stock market, and stuff that I'd find in the NASDAQ. The larger companies give you a lot of stability as the market falls. As I mentioned, blue chip stocks often don't fall as far and often are the first ones to rebound after tough economic times. Also, I wanted to say that there's a million different ways to trade the stock market, but in this video, I'm going to be specifically talking about long-term investments. If you want me to talk about how I look for short-term stuff or for option trades, let me know in the comment section down below, but the rest of this video is going to be focused on buying and holding for at least a year. The first thing that I look for as my criteria for a long-term investment is finding a company that I like and use on a regular basis. The reason behind this is if you feel comfortable with a company and kind of the way they've been run over the past couple years, if the stock falls 15%, my first thought is, are you thinking about selling, or are you thinking about, oh wow, this is a discount, I'm ready to add to my position? As the stock market continues to fall, 15% move is not unheard of. We've seen that happen in just a couple days. So taking a position right now, there's definitely a chance that the stock market is going to fall further. So having a company that you can trust and not be upset that it's down 15% is one of the biggest factors that would kind of push me in a direction towards taking a position. So at this point, the way I would scan for companies to own is I would look at the listings of stocks on the Dow Jones and the NASDAQ. As I mentioned, these are the 30 and 100 largest companies on the stock market. And to mention, we're looking for blue chip stock. So I'm gonna be looking at the Dow Jones, which are the 30 largest companies. I'm gonna be picking out stuff that I have not talked about a lot on this channel or I have not actually owned. So this means I'm not gonna be including stuff like Boeing, Microsoft, McDonald's, or Nike, stuff that I really enjoy. But in this video, I wanted to show how I would come up with new companies to own. So I'm gonna go through that list and pick a couple of them that kind of stick out to me, stuff that I've used a lot in the past and I trust the company. So for the rest of this video, I want to talk about the 4 companies that I picked out of that list. I'm going to talk about Home Depot, ticker symbol HD, Intel, ticker symbol INTC, Disney, ticker symbol DIS, and then finally I'm going to bring it up with Walmart, ticker symbol WMT. These are 4 companies that I've not owned in the past, but I've only heard a lot of good things about them, and they're relatively stable. So during normal times in the market, after I find these 4 or 5 companies that I want to look at, I would go and look for potential support and resistance lines. The reason behind that is I'm mainly a swing trader, meaning that when I look to enter a position, I'm looking for an entry, an exit, and a stop loss. Picking those areas means that I can get in and get out of position relatively quickly, and I don't have a lot of emotions attached to it. However, during a time like this, that's really not realistic. The market's going to continue to fall most likely, so I'm going to be picking stuff that I'm going to compare it to its 52-week highs to see what type of discount I'm getting on these companies. So looking at these 4 companies, Home Depot is at a 25% discount, Disney is at 38%, Intel is at 25%, and Walmart is relatively stable, being down only a couple percentages. So now that we have an understanding of how far things have fallen since the relatively stable January, we can kind of see what type of companies we want to take a position in. And now we get to the more difficult part. It's really easy to just look at a chart, see what type of discount you're getting, but as you learn more about the companies, it's harder to kind of pick which companies you prefer over the other ones. So when you're looking at these companies, there's a lot of different ways you can play these stocks. So you can look for overall stability, you can look for a great discount, or you can look for dividends. So going through these 4 companies, I'm going to talk about what I personally see with them as being the pros and cons in each one of them. So for the first one, for Home Depot, the price has fallen around 25%, meaning that the dividend yield has gone up a decent amount, sitting around 3% right now. In my past videos, I've talked about 3% not being an amazing dividend, but pretty solid. I think 3% is my perfect area for a dividend right now for these couple reasons. First off, 3%, it's hard to complain about a 3% dividend, but the biggest one is as the stock market continues to fall, you start worrying that companies that have these very large dividends are going to potentially have to cut them or suspend them indefinitely. And if that would happen, the stock is going to fall a lot further. This is a reason why I ended up exiting my position on Macy's, because they had an 11% dividend, and as the stock continued to fall, that dividend yield has continued to rise. And just a couple weeks ago, they had to finally suspend the dividend, and the stock fell a lot. But we're looking for companies that aren't at any risk of suspending or lowering their dividend for the next couple of months. When we look at Disney, some of the things I want to point out is, yes, it's a 1.8% dividend, which is decent, but it's only paid out every 6 months, so you're not going to be getting that dividend until July or December. Some of the things I want to point out with that is, if you're looking to get into this company mainly for the dividend, I would personally wait a little bit longer. You're going to get more information about the stock, and it's likely going to fall further, increasing the dividend yield and lowering your average price. But if you're looking to get in right now, it's important to understand when the dividend's paid out. Most of the time it's going to be quarterly, but with Disney, if you hadn't paid attention, you won't be getting that dividend until around July. So Intel pays around a 2.4% dividend, which is pretty on average from what I've seen, and Walmart pays a 1.9% dividend. So these aren't going to be companies that are going to be blowing you out of the water with the huge dividends that they're paying out. But as I mentioned, we're looking for stability and companies that aren't at a risk of suspending or lowering their dividends. Okay, so one of the final things that I like to look at when picking these stocks is probably the most difficult and subjective part about this whole process, and that's looking at the fundamentals. At this point, I am definitely not an expert at looking at fundamentals, but from what I've seen and the criteria that I'm looking for, the 2 big things that I'm looking at are revenue and long-term debt and equity, I guess, debt to equity ratio. So I guess 3 things, but these are the main 3. Depending on how experienced you are with the stock market, you can go and look through the fundamentals and nitpick pretty much everything on there. But I've kind of gotten to the point where I've found what I think are the most important things with revenue and long-term debt and kind of found my criteria for that. That criteria may be good for you, but for some people, they may be looking at plenty of other things. So this is a very subjective part. When we look at the stocks and look at how far they've fallen from the top, it's just a number. It's really easy to tell. But when you're looking at ratios and the increase in revenue over time, that's very subjective on how people think the increases have been over time. So the reasoning behind these criteria is that we've just come out of the longest bull market in history. So I want to see that the company has increased their revenue over time during these incredible economic times. And so if I see drops in revenue for kind of questionable reasons, that'll be a big red flag for me. And then long-term debt, because as we're likely going to be going into a potential recession, I want to see that they have enough cash on hand to survive through this tough time. If their long-term debt has been spiking and their equity has been decreasing, that is one of the bigger red flags for me. So when I go through these 4 companies, when I look at Home Depot, ticker symbol HD, I see a nice increase in revenue with a dip around the last recession, which is not a huge red flag, but it's something to pay attention to. But when I look at long-term debt and equity, this is where the big red flags go. So when I look at the debt to equity, you can see the debt has been increasing for a long time and equity has been decreasing, meaning that their debt to equity ratio has been spiking. And it's gotten to the point where equity is so low that it's now negative. And I've talked about that in the past. That just means a negative equity means if they sold everything in their company, they would be negative on their price. When you take into account that Home Depot historically has not done very well during recessions, and if you think that a recession is coming, these are going to be big enough red flags that they're going to take them off my list of potential stocks to buy. Next, I want to look at Disney, which has an incredible growth in revenue over the past. The long-term debt has been increasing, but it's been balanced out pretty well by the increases in equity. So looking at this, I give it a thumbs up for the revenue and pretty neutral for the debt to equity ratio. From what we've seen, some of the main problems that are going to be associated with them is the fact that their theme parks are closed down. But if you're going to be considering taking a long-term position in a company like Disney that has so many different fingers of their business, I highly recommend figuring out where their revenue sources are coming from and to determine what type of hit we're potentially going to see when the next earnings report comes out. When I look at stuff like Intel, I'm pretty neutral across the board. Revenue has been increasing with a dip in the past recession, which is pretty expected, kind of similar to what we saw with Home Depot. And the debt to equity ratio has been relatively stable and it's still sitting below 0.4, so it's pretty neutral. Based off of the other companies that we've looked at, I put it right in the middle. It's not blowing me out of the waters with the financials that I'm seeing, but it's not anything that would bring up any potential red flags like what we saw with Home Depot. And then finally, let's take a look at Walmart, which has one of the most stable increases in revenue I've ever seen when it comes to fundamentals. And then we look at long-term debt. The long-term debt to equity ratio has been increasing and it's up the upper range of its historical range, but it's not a huge red flag to me, so I'll give it a thumbs up for the revenue and pretty neutral for the long-term debt to equity ratio. So now that I've talked about what I look for fundamentals, it's getting to the point where you need to decide what exactly you're looking for your positions. If you're looking for overall stability, Walmart's going to be the company that you're going to be looking at. It has not dropped that much as the market has fallen. Some of the cheaper retailers have been stuff that I've talked in the past that have done relatively well during this crazy economic times, especially when I talked about the drugstores getting outcompeted by stuff like Target and Walmart. This is not a company, however, that I would consider taking a position in. It may be a great option for a lot of people, but for me personally, I'm looking to take advantage of this incredible discount that we've seen in the market. So for people that are looking for low risk, low reward, Walmart is a great option. However, I'm looking for stuff that I can be very happy that I bought during this crazy dip. And for that reason, Intel, ticker symbol INTC, and Disney, ticker symbol DIS, are the two companies out of this list that I would really consider taking a position in. They are companies that are at a significant discount, with Intel being down 25 and Disney being down 38. They're companies that I really believe in and trust, and I would feel very comfortable holding if the stock fell 15% tomorrow. So obviously at this point, you're not going to be finding the perfect stock to take a position in. Pretty much everything has been hit as the market has continued to fall. But picking out stocks that you consider taking a position in the future, I think is an important step to trying to take advantage of this incredible discount we're seeing with the stock market. Obviously, this whole process is very subjective, and the way I trade stocks is not the way that you're going to be trading stocks. But I thought it was important to kind of share my thought process for how I pick stocks, because for people that have not been around the stock market very long, it's kind of a daunting process. At this point, I know a lot of stocks. I've looked at a lot of charts, but I get to the point now where people comment stuff in my videos to take a look at this stock, and a lot of times it's companies I've never heard of, more of the smaller stocks. So for someone right now that's maybe not as experienced in the stock market and is trying to take advantage of these dips, it's very daunting to go through a list of all the stocks out there, especially when you don't know a lot about these companies and what's a very good deal. So my criteria of looking through the Dow Jones or the NASDAQ for companies that you know and personally use, I think is probably the most important part of this video. There's definitely a time and place for picking speculative stocks that you can find as the potential home run stocks are going to make you a lot of money in a short amount of time. But as the market falls and volatility is really high, picking blue chip stocks to hold in your portfolio for a long time, I think is probably the best option out there. So as a result, going through this process of looking through the Dow Jones, picking 4 potential stocks that I would look at, looking at their fundamentals, how far they've fallen from their highs, the 2 companies I would consider to own would be Disney and Intel. So let me know what you thought about my process. Which companies are you looking at to maybe add to your position or maybe lower your average cost in your portfolio? Let me know in the comment section down below. Also, if you have any topics or just companies you'd like me to go over in a future episode, please leave them in the comment section down below and I'll get to them as soon as I can. Thanks for watching this video. Stay inside and I'll see you in the next episode.